Deepesh Head Investments with IIFL Capital joins us via Skype live from Singapore. Deepesh, morning. Thank you for joining us. Deepesh, Indian markets have appreciated by about 15% plus in absolute terms and 20% plus in dollar terms this year. At these levels, after the recent run-up, are Indian markets looking slightly stretched?
The pace of run-up has been very steep. Nobody was prepared for this and nobody was expecting it. You've seen clearly overly beaten down sectors and stocks, participating quite well in this rally. In the very short term, yes, there's a possibility of consolidation. There is possibly a need for some bit of correction, and it's a good time to maybe trim some positions, trim some stocks which have really done up a lot, where fundamentals don't support. So it's a good opportunity to do that. I would expect markets to consolidate now.
Deepesh, in the near term, on the global front, does it seem like the outcome of Greece and what transpires out of the crisis there is going to be extremely crucial by way of fund flows for markets like ours as well?
Yeah, it will be, because really, if you see this rally, it has been driven totally by foreign flows. Domestic investors have been sellers. They've sold quite aggressively, especially in the last few days. So the rally seems to be driven by emerging market flows, which seem to be at record highs. If you see, the weekly data which comes out on emerging market fund flows, that seems to be at a record high. India has benefited tremendously from that trend. So yes, I think global sentiments and the risk-on trade which we are seeing right now, that will be a crucial, determinant of the strength in Indian markets. So we got to keep our eyes open for what's happening in terms of situation in Europe, particularly in Greece, and in US in terms of these flows.
Deepesh, so if the fundamental turf has not changed, if the news flow is still poor, what is fueling liquidity to a market like India, and how can a retail viewer figure out that liquidity is here to stay or liquidity is about to get over?
While I would agree that fundamentals haven't changed that much, I would also like to emphasize that second half last year, more specifically the correction which we saw in November, December was excessive. You saw Sensex falling all the way down to 15,000 levels at 11, 12 times. And that's where typically market has bottomed out. You saw some of the interest rate sensitives and some of the infrastructure, property, banking stocks falling much more sharply than the underlying index. So a bit of a bounce back is justified. What we've seen this year, valuations are just coming back to more normal levels. Result season also, especially for banks, etc., hasn't been that bad. Therefore, a bounce back in those sectors and stocks is justified. Going ahead, I think markets always discount future in advance. We are beginning to see an interest rate cut cycle going ahead. Fundamentals should gradually improve. Obviously, a lot will depend on what happens in the budget, and election results outcome will also be crucial. So these are some of the things. I will not get overly biased by the sharp move in some of these sectors. I think some of these were oversold and therefore they're coming back to more normal levels. So I think with some bit of correction, next 12 months should still look reasonably good. For a 10 to 15% rise in large cap stocks. That's the kind of outlook I would hold at this point of time.
Deepesh, so given the fundamental uncertainty, at least in the near term, with what happens in the elections as well as the budget, and more importantly, what is the outcome of the next credit policy meet and whether we actually see interest rates cut coming in, is it time to turn cautious on the market, and would you then have a defensive approach in terms of sector positioning?
As I said earlier, it's a good opportunity to do some cleaning up in terms of portfolios. There are sectors and stocks, especially in infrastructure, engineering segment, which are still under pressure, which will remain under pressure, and some of these stocks have also participated in this rally. So it's a time to trim these stocks. I would still hold a positive view on financials. Banks, I think, are doing quite well, at least private sector banks. So that kind of a bounce back in those stocks is quite justified, considering that they fell quite sharply last year. So it has to be selective. I don't think it makes sense to go defensive, because defensive sectors in India are not defensive in terms of valuations. So at best, in a small correction, they will help you in holding on, but in a rising market, they will not, make you money in absolute terms. So I think it's a time, to be much more sector focused, stock focused, rather than, being defensive. And it's a time to, kind of clean up portfolio in terms of some of these sectors, which have run up without, support from underlying fundamentals. Yeah.
You talked about a 10 to 12% growth across large cap pockets. Do you think it is mid caps which will actually project better traction from the current levels?
Quite obviously, because mid caps and small caps have done quite badly last year, and even year before that. Valuation gap is still quite big between mid and small caps versus large caps. So I think in terms of outlook going ahead, a broader market should do far better, and we are seeing already that trend in January and February, where mid caps and small caps have outperformed the large caps. So that is a space which looks very interesting in terms of bottom-up ideas, in terms of valuations, and that segment should definitely do much better over the next 12 months.
So Deepesh, let's nail it down to specifics now. What is on your current buy list and sell list?
In terms of buy list, I think government-owned banks selectively, private sector banks has always been a favorite. But besides that, I'm saying some government-owned banks also look good, because slippages and restructuring hasn't been as high as as was the expectation. I am also looking at some of the retail NBFCs. I think retail loan growth and the environment is very, very strong, and some of these companies are still growing at 30-40%. So retail NBFCs is another space. I would also look at some of the media stocks. There should be a recovery in ad spends going ahead, and consumer companies can't just keep on keeping their ad spends depressed. So that's another segment which looks good. I think pharmaceuticals, IT services, those are the plays, where you can have some allocation to those sectors for their defensive nature and reasonable valuations. I will not get into consumer staples at these valuations. In terms of sectors and stocks which I would sell, I think infrastructure asset owners, some of these stocks have risen. Construction companies, still are doing quite badly and will continue to do so. So these are some of the segments which I would like to trim.
You think banks can do well at a time when construction stroke infra companies are not doing well? Because banks lend money to infra projects, banks, they give money to some of these asset owners. If asset owners and infra companies are not growing, banks will find it difficult to make money.
Again, you got to differentiate between various banks in terms of their exposures. You got to look at banks' exposure in terms of operating assets versus assets which are yet to come up. And I think private sector banks specifically have done a good job in terms of picking up those assets and investing in those assets which are more safe. They have better collateral, they have better security cover. A big part of infrastructure is related to power generation and distribution. Distribution, you're already seeing reforms. You will have restructurings, but these restructurings will not impact P&Ls. And some of these assets, in any case, will come up over the next 2-3 years. So impact will be much more gradual. And looking at the various strategies, to revive these assets at the government level, there should be improvement in these. So again, as I said, private sector banks have done a good job in terms of picking their assets, and that's a segment which I'm more comfortable with. Government-owned banks also selectively, some have done well, and again, valuations are very good over there. So that's another segment which I will look at.
Right.
Deepesh, so let's nail it down to one large cap stock idea where you're fairly confident of a 20% return in next 12 months. That's an easy question.
ICICI Bank is one name which should do well. So that's one large cap, and that represents the private sector basket, which I am fairly bullish on. So within private sector bank space, you could look at ICICI Bank, and you could look at some other banks. So that's one name which I would think should do well.
And what would be your 12-month price target in ICICI Bank? Currently, it's at 921 thereabouts.
I think it should easily deliver about 20-25% returns. And that's the range where it starts hitting its average multiple over last few years. So in an improving scenario where monetary situation is improving, rate cuts are taking place, this bank can easily go back to its average multiples, and so that's the upside I see for this name.
The fact that Temasek, which has been a very long-term investor in ICICI Bank from last 10 years, they have sold 1.3% stake in ICICI Bank today. Does that bother you that a long-term investor is now exiting that bank?
You must remember that private equity guys have seen very few exits, very few successful exits over the last 2 years. Therefore, there's a rush, by private equity players to exit, whatever they can, at least in large cap space. And therefore, I see, the transactions which have happened in banks, and there have been 3 transactions actually over the last, 1 month in private sector space. These are just indicative of, a profit booking. I don't think it's any kind of view on the sector or on the stock in particular.